Okay, hi everyone. This is Russ Connie with Club Benchmarking. We've still got some folks coming in, but I think we'll get started for the sake of trying to stick to our schedule. I appreciate everybody joining today. I think it's going to be interesting session and interesting timing. It's clearly a topic of interest. We actually ran this webinar last week, and we topped out at well over 100 participants, and it looks like we might top out again today. So it's clearly a topic that, I think part of it's just general interest and part of it's the timing of the year. We know that, everybody is, not everybody, about 50% of clubs are in the process of setting their budgets for next year. About half the clubs in the industry are December 30th year-end clubs, so they're all in that process now. So just a couple housekeeping items. There is a chat window down on in your wherever your GoToMeeting control box sits on your screen. So if you have questions there, you can put them in there. I'm not sure we're gonna be able to get to all of them, but we'll do our best to scan through and try to hit the questions that come in. And then, we are going to have, with so many people, we've got over 100 people on this webcast. So, everyone we're going to maintain everyone in a mute state other than me. And, we could always open up someone if we need to. But generally, we'll keep everybody muted. Otherwise, we'll have folks stepping over each other with audio. So, today's session is about using benchmarks in the budget process. We actually call it strategic benchmarking for clubs. As I just talked about, the budget process is always an interesting time for clubs. It's often, it can be a frustrating time and a challenging time, and I think some clubs do it a little bit better than others. But we are going to discuss this notion of strategic budgeting and what does it mean and how does it sort of compare to the other budgeting methodologies that are out there. So we're going to just take a few minutes and talk about some of the other budgeting methodologies that, frankly, most clubs use, and then fold in, what do we mean when we say strategic budgeting? And while certainly there's a lot of good information here for folks, whether they're subscribers to Club Benchmarking or not, this one is a little bit different than some of the other webinars. This one does have a couple slides in it where it does sort of pertain to, okay, if you're a Club Benchmarking subscriber, go take a look at this, or here's a feature you may not be have been aware of. So I will do that a little bit, but I promise just for a minute, and it's just to let those folks know. I think it's roughly 50-50 on subscribers versus non-subscribers. So it's a great mix of folks. So as we move forward, this whole notion of budgeting, or the whole process of budgeting, what is that really about? Obviously, it's for setting the financial, revenues and expenses for the coming year. But ultimately, what you're sort of trying to do, the budget process of any organization ultimately is about trying to make sure that your entity is in a financially sustainable state. So, what does financial sustainability in clubs mean? I mean, I came up with this definition. It's not rocket science, but I came up with this a little while ago, and I like it. It's useful. Basically, it says if your current operational results and capital generation were continued for the foreseeable future, would the club be able to adequately fund all amenities and member experiences and be able to reinvest back in the club every year to replace, those aging assets? And, the sustainability really does require both of those, because you can be operationally whole, meaning you're at a break even, but if you're capital starved, clearly you're not able to reinvest back into the club at an adequate clip. You might have a capital income, which seems relatively healthy and is in a good state. But if you're burning, $500,000, or you're burning cash operationally, what typically happens, as we know, is you steal your capital income to patch up your operational deficit. So that really, doesn't lend to financial sustainability either. And of course, you can have the worst case scenario where you've got both an operational deficit and completely insufficient capital income, and that's a challenging place to be. And if you know you're there, you have a shot. If you don't know you're there, it's pretty challenging. So when we look at, again, in this notion of financial sustainability, why do I've really started to adopt kind of this mentality a lot around, trying to I think it helps clubs and boards start to think more long term. It's not just about making it through the next year. It's about, if you're a 100-year-old club, you want to be a 200-year-old club. If you're a 20-year-old club, you want to be a 40-year-old club. Everybody wants to have a long-term viability for their club. And when clubs get into an financially unsustainable condition, we see some common parameters, but B, we see a particular culture that invades the club that has significant impact. So we kind of say when you're in a club that's got an unsustainable financial condition, quite often what you see is, they have, some of these parameters. A weak dues engine, they are fundamentally capital starved. You see a ramification of those that they tend to be pushing F&B, more banquets, even though the fundamental issue is they don't have enough members, or they're not charging their members enough, or maybe they don't have an initiation fee. They try to lean on that as a Band-Aid, and we know that never really works. And ultimately you get into this diminishing expectations, right? It's how much can we cut the value proposition of the club, the experience of the club, and still have people hang in there. That's this cost control mindset, expense control, where your focus, the focus of the board, frankly, often, and what you see is the focus of the budget process, is how do we drive cost out of the club? Then you've got the flip side, right? If you're on the other side of the equation, where you're a financially sustainable club, you've got that operational, break even or better, and you're throwing off a significant amount of capital at the end of the year. That has a set of attributes and a resulting culture as well. And so you tend to see, strong dues engines there. You tend to see healthy capital income and healthier initiation fees. And we can draw, I don't have time today, we can draw distinctions that clubs that have confidence in their value proposition have higher initiation fees, and that drives, value creation cultures, and, it really feeds on itself. But you're about services and amenities, so you don't try to make money on F&B. You realize that you want someone to buy a $70 steak and think they only paid $30 for it, even though they really made up for it in dues, right? It's the experience. And you're trying to create rising expectations, not you're not driving expectations down. We can't afford it, we can't afford it. You're driving expectations up. You're trying to get ahead of the curve on what your members and prospective members want. Now, it doesn't mean you're wasteful, right? You still obviously have cost efficiency in that notion. But, I think everybody, if you've been in the industry any time at all, you've either been at clubs or you know of clubs that are in the complete cost control perspective, and clubs that have that culture of value creation. And as a member of a club, I really know which one I want my club to be. And I think every member would, in fact, every member and staff would probably think the same way. So I need to move on from that. I could probably talk a half hour just on that whole notion of value creation and cost control. So, just quickly, the budget process can take, easily a couple months in some clubs. I'm going to talk about a specific case study where someone took that from about 2 months down to a week using the notion of strategic budgeting. But it is often a politically charged event, especially if someone's new to that budget process. They think they come in saying, hey, this is my chance to support my tribe or to fix what I think is broken. And, it can be very agenda driven, which is problematic. Everybody has been through those scenarios. At the board level, you really want to try to focus the board at a strategic level. And that's where we're going to really talk today. It is the business indicators that aren't just reflective of how the club did last year, but are predictive of how the club is going to perform. And that's what we're going to talk about as we get into it. But, there's a common set of questions that always arise around the budget process. And they're valid questions. I think the weakness in the process that's existed in many clubs is the ability to answer those questions properly. Should we have a dues increase? Hey, should we be making money on F&B? Are we spending too much or too little on, you pick your topic, on the course, on labor, on whatever it might be. Are we funding capital adequately? Actually, that's probably a question that isn't really asked often enough in the budget process, and it's a fundamental question. But, these are good questions, but that's only one side of the equation. You want to be able to answer those questions effectively, and on and on and on. You all understand how that works. So when we start to talk about, budgeting methodologies a little bit, and we look at one budget process called zero-based budgeting, It's a pretty simple notion. Zero-based budgeting basically says you're going to start with a blank sheet of paper every single year, and essentially every line item in the budget needs to be justified to some spending level as to why that's needed for the coming year. It does enforce a lot of discipline. We're going to talk about pros and cons of each one of these, but it obviously has some significant challenges to it as well. Then you've got baseline budgeting. Baseline budgeting, which is really what most clubs use. It's what an awful lot of organizations use. It's probably the most common method that all entities use. And baseline budgeting simply says, hey, let's take last year's budget or last year's results and use that as a benchmark for setting what we think our forward year budget's going to be. It's very rational and very straightforward. Then you've got the notion of strategic budgeting. So it takes a little bit of components from the other two, but adds an important third layer. So strategic budgeting basically says, let's not just take our own experience in our club and say, what did we do? And let's just sort of keep doing that to the same level. But it says, well, let's have some non-emotional, disconnected politically and emotionally data points that we can apply and say, is in fact, going with a baseline and using what we've been using, for the past, several years, going along with that, does that still work? Applying industry norms and industry measures on top of your budget, so you've got that extra level of intelligence and confidence. That's really what strategic budgeting entails, and it has impact, as we'll see, on I think the outcome of the process, and I think on certainly the effort that it requires to complete the budget process. So if we're just very quickly stepping through these, because I do want to get to the more the meat of this, but zero-based budgeting is a slower process for sure. If you've got to start from a zero blank sheet of paper on every line item, that takes some time. It takes lots and lots of discussions, lots and lots of people involved at every different level. It is good because it does enforce a discussion of levels and priorities. It says, hey, why do you need that, $100,000 for this or $20,000 for that? But at the same time, is it really effective to have a discussion around, why does the laundry bill, going to be $15,000? Can we get, you can get into the minutia in that process, obviously, and it can amplify the tribes and politics because you're looking at every line item, and you tend to do that in a set of smokestacks. When you get to baseline budgeting, obviously it's quicker. You have a baseline to start from, but the real fault of baseline budgeting is it makes the very critical assumption of saying that the allocations and priorities that we've been using are in fact correct, and we should just keep rolling that forward. So, in the case where you've got, let's say, a weak dues engine and you didn't know it, or some other indicator that's out of whack and you didn't know it, by using baseline budgeting, you obviously just propel that same inappropriate level of prioritization forward. Maybe you've got your G&A spending, way below where it should be, and you've got the club under stress because of it. The staff is under stress, right? If you don't have some way of knowing that, you're just going to keep doing what hasn't been working, and that obviously is a problem. When you get to strategic budgeting, and here's where I'm going to tell a little bit of a story. I mean, it is a faster process with, I think, greater confidence because when you've got now some dues level or some spending level, maybe it's a spending level on the course, but you've got a set of indicators that say, we're pretty much doing what everybody else does, and by the way, here's kind of the results that tends to bring from everybody else. That applies a different level of confidence as opposed to going with, who pounded the table the hardest, or kind of was the most dominant voice in the room for that day. It does budget the entire business. That's another significant factor. It's not about budgeting, food and beverage department, budgeting G&A, budgeting, course maintenance. You do, obviously, those things come out with budgets, but at the end of the day, you're trying to set a budget that maintains the health of the overall organization, the club, right? I mean, it's financial sustainability. That's what you really want. You want to reinforce the financial drivers that then people understand what those drivers are, and you want to mute the things that aren't financial drivers, right? Intense focus on cost of food, right? is not a financial driver for financial sustainability, long-term financial sustainability. So you want to elevate the important stuff and you want to mute the less important stuff. And it does, it does obviously offer people the ability to understand the big picture. And as people that, have heard us before, we do embrace very much a standard business language instead of sort of realities and measures. And so we think the more you can bring standard business language into the process, the easier it is to reinforce with the board and finance committees that, no, this is a business. It has a gross margin, it has capital and leverage ratios. And so those kinds of things are really important. Just to tell while I have this slide up, this was a club that's a subscriber out in the Pacific Northwest. It's a smaller club, but it's a club that had the same challenges. Very high power set of folks on the board. Clearly sharp people, and they eat in restaurants and play golf. So clearly they know how to run a club. And so you had this 2-month process that they would go through like everyone else. There's multiple iterations, and eventually you'd get out the other end. So this actually was this GM in particular kind of helped us sort of embrace the notion of strategic budgeting as an actual concept. But he said, I'm going to do my budget like I normally do up front, but I'm going to run all my indicators. This is where we get a little bit to the member side of club benchmarking. I'm going to run all my indicators, and I'm actually going to set without them. I'm going to set the budget using these indicators, the dues ratios, food and beverage to gross profit, payroll ratio, some of the ones that every club can do. We'll go through them specifically, and I'm going to just create a little cover package of, the 6 or 7 or 8 slides that show these are the business level indicators that we will hit if we in fact, implement the budget that's the 50 pages, beneath these 5 or 6 or 7 top level charts. And so we brought it to the first meeting, and they're flipping through it, and they went through these 6 or 8 charts, and the comment from the chairperson was, first he asked about where they got the data, and he kind of explained that and said, does this put us, in a good condition, and are we basically running what would be considered along industry norms? And he said, yep, that's exactly why I use that data. This makes us, predictably down a very healthy place. And he actually said, that's great. I have no further questions. Does anybody else have any questions? And there were not any questions. Now, I'm not saying you can get there in one shot, but that was a pretty powerful example of, I think, what can be done here. In fact, then he did it the following year, this past year, handed out the same exact package. And the only question at that point was, is this the same package that you handed us last year in terms of indicators, and do the results line up like they did last year? He said, yes. And they said, I don't think we have any further questions. So it's very powerful when you can come in saying, look, we're not just making this up. We're not setting these things just because, we're just pulling these numbers from somewhere. They have validity. So, that was a powerful notion, and it's an interesting story. And I have to talk to the GM because I'd love to be able to tell you who it was specifically, because it is an interesting club at the same time. So, it is important to generate the questions you need going in, but these are business level questions, right? These are questions that folks and I need to get moving a little quicker here. I want to try to keep us, we'll be a little more than 30 minutes, but I don't think we might be more than 40 minutes. These are the kind of questions that someone at Apple or Ford or GE, might ask at this business level, right? Things like, if you look at Fortune 500 companies, and you looked at C-level executives, and that you asked them, what was the gross margin of your business? Every single one of them would know. But in the club industry, people don't, they're starting to now, but they haven't used those indicators. So you want to be able to ask and answer those business level indicators that have that, correlation to the bottom line result of the club. Basically, are we supporting our operations with a sufficient gross profit to pay off our fixed operating expenses? And does the allocation of those fit our strategy, right? And when we look at things like, split between course maintenance and non-golf sports, right? That's where spending and strategy meet. We'll look at that in a minute. Capital obviously is self-explanatory as to why that's A, critically important, and B, not given enough attention in the boardroom, in our opinion. So, the reality is we've been doing this now for 7 years, and folks that use the platform or have just heard us talk, I've heard us talk about the executive dashboard and the indicators that are within that executive dashboard, a very business-like view. And we now know that in fact is an extremely telling view of how the club did in the previous year. And it paints a story of the club that frankly, prior to that was pretty hard to paint. You could sort of guess and be intuitive about it, but you couldn't really know for sure. So the obvious question is, well, wait a minute. If those indicators are highly telling looking backward, right, looking reflectively, why wouldn't we use those exact same indicators and stack them up against our budget and actually say, this is what those executive dashboard level indicators are going to look like if we hit these budget numbers, right? But knowing it 12 months ahead, you're not waiting 12 months to find out. That's pretty important. That's what a lot of top level consultants and Gartners and folks like that in the industry. It's called predictive management. Every organization wants to try to put predictability into their business. And you can't get there by just saying, well, we're shooting for an operational break even or an operational surplus. The way you get to predictive management is you say, I need a 60% gross margin because I know that correlates to operating result. I need a 50% dues ratio. I need a 52 or 53% payroll ratio. These are things that are actually under management control. Doesn't mean they're all easy to control, but they are under management control and board level control. How much you charge for dues and how hard you go for more members and labor ratios. And if I hit these things that I can manage, I'm actually going to end up with the operating result I want. So you manage towards the things that you have some control over, knowing that those things correlate to the result you want. Right? That's predictive management, and every organization, including clubs, should strive for predictive management. So I'm not going to go through every one of these, but a lot of people have seen this. This is just the list of executive dashboard indicators that we have used reflectively. And now people are actually starting to use this. There's a feature in the platform that we turned on about 6 months ago. Everybody doesn't have it because if you were quote unquote, a legacy, an early member, and we've made some changes, you have a little bit reduced price, but you don't have that financial forecasting feature. So you have to do a very minor upgrade to get that. And what it does is turn on a section that allows us to run all these kind of indicators against your budget. And so, this is now kind of what we call the perfect, cover sheet for your budget. And in fact, when you run a report, it stacks you, it would list your budget here, and even current working views can be run. But so now when you've got a board looking at things like gross margins and dues ratios and capital incomes and capital ratios and, dues, debt ratios, as opposed to what's our cost of food going to be next year, it's a completely different discussion, right? This is a business financial sustainability discussion, and it's where you want, it's where you need to be, up 50,000 feet, not, down right at ground level. Just to tie how this whole thing comes together in terms of that model, because it applies to the budget too. You've got budgeted revenue and cost of revenue. We have our obviously equations to get there, which generates a gross profit, and that's what you use to fund all the fixed operating expenses of the club. Now, by the way, fixed expenses doesn't mean you don't have budget control over it. It just means that once you set that budget, it's not impacted by actual volume, right? Your G&A doesn't change by, how many members come in on a particular day, whether someone brings in a guest member or not, your course maintenance is the same. They're fixed once you've basically set them. And then your net operating result feeds over to your capital ledger, where you take your other capital income and lease expenses, and you end up with that net available capital. But, so this is for the folks that have access or want access. This is where that financial forecasting section is. If you are in your budget process and you haven't used, this section, contact us. All you have to do is, if you've got one of the accounting systems, the big ones, and you load your budget into that, you just generate that back to us, just like you would a trial balance file, and we're going to map and load it for you, and you're going to be able to run in one click that budgetary dashboard report with those indicators. And I would strongly advise folks to to go ahead and do that. If you're one of the few folks that is very, very tardy in getting us your 2015 past trial balance, please get us that as soon as possible, and then we can work on the budget side as well. Which basically, this is what I just said. You send us that trial balance view of your budget, and we'll map it. But and you instantly have your indicators for your budget, not just for past years. And you can run reports at the same time, specifically geared towards your budget. So now let's take some time and look at the actual indicators. I recognize I'm running late, but we're getting to the data now. Some of these for the non-members, because I always like to give valuable data for the non-members as well as members. Everything you see with a star next to it, this is a number that you can really easily calculate yourself, right? Everyone on this call could say, what's the dues revenue going to be, and what's our operating revenue going to be, and do that ratio, right? Everyone should know, obviously, coming out of your budget process, what's our operating result? We'll show you how to use that. Payroll, what's our total loaded payroll divided by operating revenue? What's our debt principal divided by operating revenue? What's that, net available capital might be a little trickier, but basically it's capital income plus or minus operating results, less lease payments, that number divided by your operating revenue. That's your capital ratio. So, if you're a member, great. If you want to be a member, great. If you're not a member, you can still run some of those things. So when you look at gross margin, I'm not going to go through everything here just because there are other webinars and we talk about this a lot and a lot of people have seen this. But, the notion in the budget process for boards is our gross profit, just like any company, you have to sell the right mix of things to get the right gross margin and gross profit. Our gross profit comes from dues and golf ops net in this industry. If you're a golf club, it does have a little bit of an F&B or sports component on the city and athletic club side. But for golf clubs, that's where your gross profit comes from. Where does that gross profit go? Having this picture of, in the budget process, for forward looking, of where that gross profit comes from and where it goes, what your allocation is vitally important to the board and to the budget to understand the budget process, right? So if you lay out, your past year and you run your executive dashboard report and you've got your sources and uses, and then you put in your budget and you run your budget, and your pies effectively look the same, it says you've really got the same strategy in terms of where our cash is coming from and where our cash is going. Now, that might be important if you're a club that says, we're trying to become a more diverse country club, not so much a golf club. In our vernacular, that means you're growing the yellow slice and shrinking the green slice, right? Because yellow is non-golf sports. And if your pie chart year over year is exactly the same proportions, you'd say we might be talking that way, but we're not acting that way, right? If our intent is to drive fitness use, drive tennis, drive pool, then that's got to be reflected in your budget. And the budget always, the budget is the ultimate arbiter of the priorities of the club, right? How much is going to overhead on the top half? How much is going to the fun stuff? And then what's the allocation among them? Very, very important to take a look at that. And we know, obviously the gross margin is the important number. Why is it important? In any organization across any industry, higher gross margin, right, up the curve, means a higher operating result. Lower gross margin means a lower operating result. And we see how dues ratio impacts that gross margin, right? Higher dues ratio gives you higher gross margin. So these very, very simple things, if this is even a 20-minute discussion with the board as an output of the budget process, or actually an input of the budget process, that changes the type of discussion you have. And everyone anyone in the boardroom who's a business person will get these relationships, will understand the importance of knowing gross margin, understanding how it funds fixed operating expenses, and understanding how it correlates to the bottom line health of the club. If we know it's important to see that from the year you did past, it's even more important to see how it's going to be predictive for the year forward. Very, very critical and very, very powerful. Here's one everybody can do. Really simple. Dues ratio. Take your dues. Nobody should come out of their budget process. I know I'm sounding bold here, but this stuff, I really believe in this stuff and it works. Nobody should come out of their budget process without knowing what is my dues ratio, right? It's the simplest thing in the world. Total dues revenue divided by total operating revenue, not including your capital income. We know it's been the same for 5 years running, right? The industry runs at 49, 50, 51% at the median. And we just saw the impact of dues ratio on gross margin and operating result. So if you're setting your budget with a 42, 41%, 43% dues ratio, and what's that predictive of? I mean, this is predictive management, right? What's it predictive of? Barring some other unusual scenario in the club, there are some clubs that get away with that for different reasons I won't go into now, but by and large, if you're coming out of your budget process with a low 40s dues ratio, I can be pretty predictive of you're going to have a struggling operating result at the end of the year. And if you've got that, as a baseline view, hey, we were at 42%, looks like we're going to be at 42%. You have to use this data to drive the board to say our number one goal in the coming year is to drive that dues ratio up closer towards the median, right? I don't know how far you get in 1 year. Number one goal. So what does that mean? More members, or members are not paying enough dues? And obviously we have indicators that look at that. We're not going to talk about them today. Everybody should know that coming out of their process. Net operating result, we talked about that. I won't go into that anymore, but we know the correlations between some of these indicators and the net operating result. Food and beverage, this one's a little bit tougher if you're not a member, just because there is this food and beverage result divided by gross profit, and gross profit comes out of the platform automatically. But here's the real key. I think that in the notion of strategic budgeting relative to food and beverage, it is how you view food and beverage is a choice, right? Do we view it as an amenity? Do we view it as a profit center? One of the best phrases that I heard, this came out of one of the professors we worked with from UNH at the last CMA conference. We were doing a bunch of studying with them, and he said, the food and beverage result is a reflection of the club's financial health. It's not a driver of the club's financial health. That's a beautiful way of saying what we've been saying for multiple years. The clubs that are driving food and beverage as a profit center, in reality and in their budget process, assuming it in their budget process, those are the clubs that are generally, pretty consistently struggling financially. Their typical issue tends to be that they have a weak dues engine, and what they're doing is they're trying to drive food and beverage to patch up that financial deficit. The clubs that are really healthy, they're the ones that are throwing the most subsidy into food and beverage. They want it, that's an amenity. They want people to come in and say, this was unbelievable, the service and the food, and the bill was so cheap. And that's a financially healthy club. So their choice is to say, this is an important, now all the surveys that McMahon and folks do, a lot of them come back and say now that it's not golf that's the expectation driver once they're in the club. It's food and beverage. So I love this notion of it's a reflection of financial health, not a driver of financial health. And I think if we can all work on, having boards understand that and have that reflected in the budget process, that's a good thing. Because here's a great indicator of that. We know, we've all seen, 3/4 of the clubs lose money in food and beverage, and one way we think clubs should budget is budget a level of subsidy. But if you look at the clubs that throw the highest subsidy at food and beverage versus clubs that try to drive profit out of food and beverage, this is really interesting. This is a great little table. We're just going to look at a couple indicators here. Group A are the clubs that they treat food and beverage as an amenity. Group C tries to drive profit, and we're going to look at some of the attributes of those clubs. Now, remember what I said about reflecting the condition of the club. The clubs that treat it highest as an amenity, first of all, obviously they have the highest labor ratio. So 82% of their food and beverage revenue goes to labor, versus these clubs, what are they doing? They're driving cost out of the operation, right? Food and beverage labor is 54%. Let's look at the number of members that these high service, high subsidy clubs have versus low service, low subsidy. Low service, I don't mean, but lower subsidy. These clubs at median have 515 members. These clubs have 319. So these clubs have more members, and let's look at the initiation fees. More members, each paying 3 times the initiation fee that these clubs that are trying to treat food and beverage like it's a financial driver, like it's a profit center. And obviously there's some reflection in dues as well. These are also higher dues clubs. So it doesn't mean you can get there one step, but it's just the recognition that regardless of where we are today, we want to get to that financially sustainable plateau where we're really meeting or exceeding member expectations. Here's what the clubs look like that are in that high service category. Here's what the clubs look like that frankly are not as healthy. We know, their dues ratios are low, dues ratios high over here. They're driving much more of their revenue from food and beverage because they're pushing it, right? You want to try to become, obviously every club, unless you're full, you want more members and you want to justify a higher initiation fee. So anyway, that's a notion around food and beverage that can be real useful for explaining the business as part of the budget process. Trying to say why are we driving a subsidy as opposed to a profit? These two charts in concert directly speak to that practice of driving it like an amenity. And then finally, I just let me do a time check here. Yeah, I need to wrap up. I want to hit another one here that everybody can do, right? Nobody should leave their budget process without adding up their total loaded payroll across all employee types and dividing by the revenue of the club, and coming out with that payroll ratio. We know the industry, again, very consistent, has run at about 55%, 54% for the last number of years. But it is the balance where you hit, member expectation, financial capability, and efficiency. They all collide at the payroll ratio. Now, generally, we know that the clubs with a lower payroll ratio, will throw off more of an operating surplus than clubs with a higher payroll ratio. And more of these clubs, especially if you get up to 60+%, there's a more very highly likely chance that you're going to end up with an operating deficit if your payroll ratio is more than 60%. So, if you're in the budget process and you're up here and if you have an operating surplus and you're up here, that's great. Probably says you have a massively strong dues engine and you can afford it. But if you're up at 60% and your budget says, we're going to have a $150,000 operational loss, this is just math, right? The reality is you really can't afford a 60% payroll ratio, and you have to say, what, we're going to have to operate at a 58, bring it down to a 58%, or move it down the curve, or there may be other indicators that say you want to move one way or the other and something else, but that would be certainly an indicator that has correlation to operating result. Everybody should be able to do that coming out of their budget process. And then obviously sufficient capital. Just on my final chart here, every club, if you take coming out of your budget, if you simply say, what's our operating result? What's our capital income? And what's our leasing payments going to be? And you add those together, right? Operating result can be plus or minus. Capital income hopefully is plus, and lease payment is a subtraction. Take that number, divide it by your operating revenue, and that's your net available capital ratio. That's the pile of money you have at the end of the year to plow back into the club in replacing aging assets or towards debt reduction or capital reserves. And we know that the industry has run consistently 11, 12% for a ratio. So if you're a $10 million club, you generate about 1.1 million if you're right at the middle of the industry in terms of net available capital, right? That's the money's left over net of the operation and capital results of the club. Very important, because we know, down to the left, capital starved. What does capital starved mean? We go into cost control mode. What does capital rich mean? We go into value creation mode, right? Two completely separate culture mentalities within a club. And the goal is to highlight these things so that if you are down in this capital starved zone or maybe heading that way, you can stem it and start moving in the other way. This is again just basic, business dynamics and business math that gets you through these indicators we're looking at. And we can see the turnover and their operating results for capital starved clubs. It's no wonder these guys, fit into a cost control mode. Well, we're going to skip through that. So, this notion of using these indicators as part of your budget process. We came in, benchmarking. People think about, I can put in my data at the end of the year and I can see how I did, which is great because it's allowed us to study the industry for 5 years and now understand that, wait a minute, we can look at this moving forward, not just looking rearward. And that's powerful. It's a powerful part of the budget process, and everybody, I believe, should work hard, whether they're a club benchmarking member or not. If you can put these business level indicators, financial sustainability indicators on top of their budget, not buried, but on the very top, it really is the health report card for the. It's like when you get a blood test, right? Glucose, cholesterol. This is that. Is my body physically sustainable? Well, this is my club financially sustainable? And it's very, very powerful and helpful. So with that, I think we're going to. I appreciate everybody's time. We're going to open up and see what questions that might have come in. I don't know. I may have to look through these myself. I'm not sure if Terry Finan can see these, but let's take a look at some of the questions. Is there a place where I can retrieve all the formulas for the dashboard indicators? It's in. We have a few booklets. So I'm not sure whoever. Bill, you can email me after the webinar, and I can send you something that'll help you show all those equations. I mean, honestly, what does happen? It sounds like a sales pitch, but some people try to build their own spreadsheets and do all this, and it's okay, it's good, it helps you learn, but you can spend a lot of hours doing a lot of spreadsheet work when, frankly, we don't think our subscription is all that expensive, and it's button click, and you can set filters and run it against clubs of whatever size or type or shape or so. But anyway, yeah, I'm happy to help you with that. I can send you that. Let's see. Here's someone who has significant banquet revenue to offset member dining. Do you have benchmarks that relate only to member F&B revenues and expenses? What we do is on the revenue side, we separate a la carte from banquet in terms of revenue, food and beverage for both. The expense, a lot of clubs don't actually separate the expenses of both. So in other words, we don't end up generating a P&L for both. But what we do generate is all kinds of indicators that show what percentage of your business is coming from banquet versus a la carte. What's the net result of your food and beverage operation relative to the gross profit of your club, and we'll get it. We can get into why. But more importantly, what it does is it stimulates a discussion around why are we driving that, and what because there's a flip side to that, right? You beat up the club depending on how far you go down that banquet factory, right? You beat up the club, you get in the way of member satisfaction, and at the end of the day, how much is it really returning to you? And that's the strategic discussion that we can help you have if we take that a little bit offline. Another question here: will the slides be available? Yeah, if you contact Terry Finan from our team, she will help you get that. In fact, this whole session, I should have said, this whole session is going to be recorded and archived, so everybody will get a link to the archive of this, and I think that will be pretty helpful. All right, I think with that, we'll let it go. I know we squeezed a lot into a short amount of time, and I know I go pretty fast when I get into that mode. So again, this will be recorded. People can access it. We'll send you the link for that. And I appreciate everybody's time, and we will hopefully talk to you soon at another event. Thanks, everyone.